So the Chinese stock market has carried on falling, even though Western stock markets have tried to rally in response to what the Chinese have tried to do to stop the rot. Let's go back to the basics. China's economy is slowing down, and that's not surprising if you look at things in the long term. Most economies that try to grow using investment into infrastructure and housing eventually run out of steam. But they especially run out of steam if their own populations, their own middle class, doesn't start spending money. Because what you want over the long term is for growth to move away from being driven by investment and towards being driven by ordinary people spending their money. And that's just not happening in China. So that's the basic problem. Now, on top of that, there's the politics. China has tried to shovel money into the hands of the middle class and the upper working class to keep social stability. So they've encouraged a property boom. They encouraged the stock market boom that has now spectacularly exploded. How? By printing money, by giving soft loans, i.e. loans that nobody expects to be repaid anytime soon, to businesses and to ordinary people, and by continually loosening up the money supply. That is what the Chinese have done. And now, on top of the exhaustion of infrastructure spending, you've got the exhaustion of easy money. And that means there has to be a slowdown. But the Chinese government, Chinese Communist Party, cannot face that. Because to them, the slowdown spells a threat to social unrest and even political legitimacy. So they do things. The first thing they did over the summer was to order state banks to spend money in the stock markets to try and keep it up. The next thing they did was to cut their currency, when their long-term promise to the rest of the world was to allow their currency value to rise against other currencies. And now they've injected liquidity. They've bunged money in and they've carried on telling state banks to buy these shares. Most Western economists would see that, frankly, as futile and not addressing the real problem. And so when you see Western stock markets start panicking about China, they're not primarily panicking about Western money in China. They're panicking about the possibility that on top of a real economic slowdown, we're going to get a financial crash. What does it mean for Britain? Well, British banks are quite heavily exposed to China. There's a lot of British money being lent to Chinese businesses. A bit of the London property market is exposed to Chinese people buying it, and there's FTSE, which a lot of people have their pension money in. That's got a lot of companies in it that do commodities, so oil companies, mining companies, and they'll do really badly if China slows down. And there is a worry there, but that's a longer term worry. For me, the biggest problem with China is it's run by an unaccountable bunch of people, opaquely, who we don't know what they're trying to do, nor do we know whether they have the experience and resilience to handle a full-blown downturn. We do know what their general response is to social unrest. I'll be coming back to the China crisis for as long as it's going on these video blogs.